Welcome to the weekly combo podcast, where I'll go over the action in the market for the week of May 27th through the 30th, and we'll see how things look for the week of June 2nd through the 6th. The markets kicked off the holiday shortened week with optimism. The S&P 500 climbed 1.9%, fueled by a tariff deferral to July 9th, as well as Nvidia's stellar earnings later in the week. However, momentum has fizzled out to this point, with choppy trading from Wednesday to Friday. The Dow ended up gaining 1.6%, the NASDAQ rose 2%, and small caps added 1.3%. Trading volume was light due to the Memorial Day weekend, though we saw a spike on Friday. The 10-year Treasury yield dipped to 4.42% from 4.51%, providing some support for equities. Mixed signals emerged from U.S. court rulings on tariff authority and trade concerns, creating uncertainty. The VIX, a measure of market fear, has remained below 20, reflecting slightly improved sentiment. Still, the technical indicators point to an overbought and exhausted market, suggesting we may see consolidation or even a pullback soon. Switching over to the InterMarket analysis, the S&P 500's CAPE ratio, a standard used for measuring valuation, sits at 36.29, which signals overvaluation. Forward PE ratios are also elevated, 27.4 for the megacaps and 21.2 for the broader S&P 500, while midcaps and small caps face headwinds from higher rates and inflation, though they are more fairly priced. Growth stocks continue to outshine value with ratios above their moving averages, though there are signs of potential weakening. Inflation trends are mixed. The CRB index is in a long-term uptrend but showing deflationary signals. Copper remains optimistic about the economy, but oil and aluminum are softening. Elsewhere, gold and silver are up, and the dollar is down against the euro, yen, and British pound, while bonds are trending higher based on price. Tech and communication are strong as far as sectors, while energy and real estate are lagging. Overall, stocks and bonds are moving in tandem, but the markets feel tired amid trade war concerns with sideways trends dominating. Now moving on to the deep dive update, the S&P 500 has posted impressive gains, up 69.17% since the October 2022 low, 44.05% since the October 2023 low, and 22.27% since the April 2025 low. It's currently just 0.87% below its all-time high and 2.19% above its 200-day moving average. The advanced decline lines are holding steady, with the NYSE above its 50 and 200-day moving averages, but still in a downtrend. Growth stocks, led by the NASDAQ 100, are coming in with a technical score of 80 and are outperforming the S&P, coming in with a score of 59. The Dow is at 24.3, while small caps are weakest at 6.5. The VIX at 18.57 suggests relative calm compared to what has been experienced, but declining momentum in oscillators such as the McClellan oscillators and MACD raises concerns. European markets such as the German DAX are outperforming U.S. markets, and normalizing yield curves warrant recession monitoring. The market remains trendless with positive undertones, but also risks exhaustion. Moving over to the What to Watch update. What's on the radar? On the positive side, the S&P 500 is holding above key moving averages, the VIX is below 20, and growth-to-value ratios are holding up. The NASDAQ 100, and Wilshire 5000 are showing resilience, with technical indicators such as the Landry Light and Chaikin money flow showing positive signs. However, there are red flags. The market is fatigued, with oscillators such as the McClellan oscillator and TRIX declining, and sectors such as semiconductors and home builders are struggling, and the Dow is also struggling to stay above its 200-day moving average. Long-term indicators such as a monthly chart of the TTM squeeze and special K chart urge caution. Keep an eye on low trading volume, rising jobless claims, stagnant risk ratios, and weak sector bellwethers such as semiconductors and transports. The gold to S&P ratio is declining as stocks are outperforming lately, while the German DAX's strength stands out. The key question we're asking right now is, will the S&P 500 resume its uptrend or stay stuck in a sideways pattern, or will it end up declining? Emotional reactions to tariff news and mixed technical signals point to consolidation with risks of short-term fatigue. Summing up the market for the week of May 27th through the 30th, the S&P 500's 1.9% gain was driven by tariff deferral optimism and Nvidia's earnings, but momentum faded into sideways trading. Lower yields at 4.42% for the 10-year yield did give support to stocks, with real estate, financials, and tech leading, while energy and materials lagged. Sentiment is improving, but overbought conditions and weakening weekly trends, as shown by the ADX, call for caution. The FOMC meeting minutes were neutral, but global debt is at $324 trillion, and a downward revision to second quarter earnings revisions do add pressure. Commodities are also signaling a slowdown, with gold down 2%, oil in the low 60s, and copper dropping 3.21% for the week. Looking ahead, June historically leans positive with a 58% chance of gains and an average return of 0.2%, often front-loaded early in the month. Expect potential volatility from Jerome Powell's upcoming speech and Friday's employment report. The markets are currently consolidating, with growth stocks leading but small caps and transports lagging. Tariff uncertainty could trigger price gaps either up or down, and risks include a potential drop below key moving averages and rising recession signals. Investors should closely monitor economic data and policy shifts for clues on the next trend. Thank you very much, and I will talk to you in the next podcast.